What are some low risk or fixed investment options in 2025? Let's go over some of the best options that we found for conservative clients or people who are retiring and want to protect their principal. So one of the most common questions that we're getting now, especially with the market volatility and how high the stock market is what are some good options for fixed investments? You know, a year or so back, a lot of people were getting 5% plus in their high yield savings, and that's dropped. So people are asking, okay, well, we want to keep up or exceed inflation, but we really don't want risk. So what are some different options? We're going to go over 3 different options that we found that are pretty good and will keep up with inflation or maybe even exceed it, that will still be very low risk and is not contingent on the market. The first option that we've been using is short-term corporate or treasury bonds now, and bond funds. So, you know, a lot of times people think, okay, well, bonds, you know, you have a time commitment, it might be there. Not necessarily. If you use bond funds, there's not necessarily a time commitment. They're usually liquid, meaning that you can take the money out whenever you want. With bond funds, the nice thing is they're based on what that bond does. So treasury bonds, short-term corporate bonds, those types of things. And as we record this, you know, in first going into the second quarter of 2025, there are short-term corporate bond funds that are still averaging over 6% in dividends and yield. This is a pretty good option, especially for those of you who have had high yield savings that were earning 4 or 5% and that's gone down. It's a pretty good option to keep your money liquid and still relatively safe, very safe and low risk. Now you have to be careful because there are, I said short-term bonds, because if you go longer term bonds or riskier bonds, you do have extra risk that comes in there. So you really want to look at the duration and the yield and talk to somebody who actually knows how they work. There's also some perks to bond funds if interest rates go down, because bond funds work inversely of interest rates. So yeah, your yield will go down, but if interest rates go down, you'll actually get an increase in the value of the bond funds, which will help your account as well. So those are all things to think about, especially as we start going towards, you know, the Fed has said that they're going to lower interest rates, and we're hearing that interest rates will likely go down in the next 2 years. That might be a pretty good option, at least for the time being, to think about if you want to keep your money liquid. The second option is MYGAs, multi-year guaranteed annuities. Now, I know what you're thinking, annuities, you know, I don't want to tie my money up forever. That's not the way they work. The way they work is like a CD, okay? So now they're typically longer term accounts than a CD. You know, most people who are doing CDs nowadays are between 6 months to a year or two. These are a little bit longer term. So these are 2 to 7 years. Typically, you can go up to 10 in the state of Florida. And what we like about these accounts are a few different things. Number one, they lock in the interest rate for a longer term. So if we do think that interest rates are going down and you want to lock in 5.5% right now for 5 to 7 years, you can do that. And you can have that rate guaranteed even if everything else drops. They also allow you to take out your interest, or usually up to 10%, which if you're looking for income, so some people say, you know what, I have, let's say, $300,000 and I want to take the interest off of it, but I don't want to touch the principal. These are pretty good options because they'll guarantee that interest. If you have an interest rate that's always fluctuating, you don't know whether it's going to be 5% next month or whether it's going to be 3. Next year, is it going to be 2 or 1 like it was back in 2020? With the MYGA, it guarantees the interest rates for whatever period of time there is. Now, once they mature, it no longer guarantees those rates. So if you go with a 5-year account, after 5 years it matures, and you either renew it and you go with a new account, or you can take it out and do something else with it once it matures. The downfall of those accounts are they're longer term. If you decide to go above the 10% that those accounts allow you to take out, there can be some penalties to them. So you need to make sure that whatever money you put into those accounts is for long term, and you have enough money liquid that you don't need access to that money at least for whatever that term and duration is. The last option that we've liked is something that we've been using for a while. It's called fixed indexed accounts. So fixed index accounts are where kind of like a CD or a MYGA, but the interest rate is contingent on what a market index does. Typically, we like to use the S&P 500 because that's the top 500 companies in the country. It's very consistent, and so we like to use that index. So let's say that the market index does 20%, okay, and it does really well. Well, the downfall of the fixed index account is you'll usually be capped out at a certain point. So let's say right now, a typical cap is around 10 to 11%. So if the market does 20, you're going to be capped out at, say, 10%. That's the most you will make. But if it does negative 20 in a year, you don't lose anything. They'll usually have guarantees anywhere between 0 to 1% for that year, and then it resets and it goes on and on. Now, if you look at that, historically, the market is up 8 out of every 10 years. So if you're looking at it and, okay, my cap is 10% and 8 out of every 10 years, that's typically going to beat the MYGAs, the CDs, even the short-term bonds, all of that, because of that consistency. The only difference is it's not guaranteed. So if you like the idea of being in the market, if you like the idea of higher potential returns, but you don't need a guarantee, you just want to make sure that your principal doesn't go down, this might be a pretty good option for you. So just something to think about. It's not an alternative for the market, because the stock market's going to make better returns, but if you don't have the stomach for those swings, this might be a pretty good option for good returns without the downside risk. If you're interested in any of the accounts that we talked about discussing more, number one, don't just go in and say, okay, I want a fixed index account, because they're not all created equal. There's some that are created for income. There's some that are created that don't have as high of caps, right? So don't just think, okay, well, Don, the guy on YouTube, said that I should do a fixed index account. That's not what I'm saying. You need to talk to somebody, preferably an independent financial advisor who can shop the accounts. Same thing with MYGAs, right? The MYGAs, you're looking at, we have a spreadsheet of all the different rates. There's some that are paying 3, there's some that are paying 5.5 for the exact same term and duration. So you have to make sure you're working with somebody that can go with the best paying one. So just talk to somebody and make sure that you're actually getting educated on the options and what all is out there. Also, remember, I'm recording this in time at the end of March in 2025. So there is a possibility that the rates or the accounts will be very different if you're discussing this in the future. So if you're watching this, say 3 months, 6 months, a year down the road or more, it might still be good options, but talk to somebody to see if it's still a good option and if it's a good option for your situation. If you want to talk to one of our advisors, there's a link to our calendar down below. Thank you so much for your time and watching our videos. See you in the next video.